Okay, midweek Q&A from the comments section. I picked out 5. I'm going to go into detail on 2 of them because they're good questions, and we can gain a little bit more insight into these. And one of them I'm going to leave for the weekend because it's asking about PPI. CPI was today, PPI is tomorrow. Question 1. Out of curiosity, I went to check how home equivalent rent was calculated. Given the big problem it has in the overall CPI, or big proportion, sorry, I was kind of shocked to learn it was done through surveys. Yes, it is done through surveys, but it is a pretty rigorous survey. I tend to think that the vast majority of equity owners have no clue of how much their property can be rented, and during periods of high increase, they would likely give a number inferior to the real rent amount. You are right, there is a lag, but it's not that they have no clue. They are given quite a lot of education and a way to think about how they would arrive at a rent. Thus, it would lag to reflect the real house market inflation. Well, that is true, it would lag. However, rents are tied to cap rates, not home prices. So you can have elevated home prices but low cap rates, which means you would have low rent. It is a market-based rent, which means you got to compete in the market. How you financed your house should have no bearing on the rent that you charge. So your capital structure of your house is irrelevant. It is a cost-up measure of what you would rent for. Would reflect the real house market inflation. Besides, a house is an asset. It is not an expense. A house is an asset, which is why in the CPI we don't have stock prices, because stock prices are assets. Asset prices go up and asset prices go down. A house is an investment, not an expenditure. Your use of the house is the expenditure, so they try to capture it. We'll screen 1 coming up is all about this. Am I missing some piece of information here? Once I explain the process in a little bit more detail, it might start to make a little bit more sense to you, but there is a problem in that there is a lag, and because there is a lag, we should not expect owner's equivalent rent to drop anytime soon. Number 2, this is coming up. I just gave you some background information. We'll get into detail on this one. Number 2, can you do a video explaining the data gathering process for your market update videos? Such as how long it typically takes you to compile all the data and what initial news sources you browse through in your day. That would be kind of hard to do, but I will be doing this in our applied series. This fall I'm adding a macro top-down process. It's macro top-down, and in that I'll give you all of the sources that are necessary, where you can get free information, how to think about it, how to start structuring your spreadsheets. And I can't just give you my spreadsheet. You really have to build your own, because there is something about being in touch with the information. You don't want to go to a website, and I thought about this, why don't I just build out some section of my site that gives you all the pertinent data that you need? It's not the same as looking at the data yourself, going to the report, taking the number, putting it in the spreadsheet, having that touch, that closeness to the data all the time, so that you have a feel for how it evolves over time. You're closer to it, you develop a better feel for it. So this is going to be added to the applied series this fall, macro top down, and off we go. But to answer your question, how long does it typically take you? I don't know, because I graze all week long. It's kind of how much food do you eat in the week? I don't know, because the fridge is right there. It's not as if I weigh it out and figure out what it is. Same with my news feed is, during the course of the day, I have my notepad with me and something will come up, or I'll read something and I'll jot it down. I'll make another note of something, I'll hear something. So it's an all week ongoing process in the background. It's not, a full day. Saturday and Sunday is where I have time to actually explore and read, and I do until I get bored. But oftentimes it's more for diving deeper into something that I that I saw or read that week. It's hard for me to say how much time it takes me, because it's just part of my day, it's part of my being, so I really don't know how long it takes. Number 3, these are staples for the weekend, immensely helpful. Thanks so much for taking the time to bring students up to speed. I just had one suggestion. Could you please expand on PPI? Is it fair to think of the difference between CPI and PPI over a period of time to be margin compression? Yeah, it is a proxy for margin compression. And PPI is broken down by industry as well, so that we can actually go in and see. If you're interested in particular sub-indexes, you can go in and actually see different sub-indexes. The PPI is being reported tomorrow. So on the weekend, being that we had CPI today and we have PPI tomorrow, this is a great combo for the weekend. Number 4, 1 hour, 12 minutes in when you go over wage growth on a seasonally adjusted basis. I'm only calculating a seasonally adjusted change of 5% in the numbers. The only numbers that equate to 10% growth rate are the index levels. That is true. The index levels are there. Please enlighten me. I got really excited when you shared this, but had trouble validating it when doing the math myself. Well, I don't know what's going on here. What's shown in weekly earnings is, okay, well, screen 2 and 3, we'll go over those tables and I'll show you how it's broken down. It's a little bit complicated because you can't just look at earnings. Right, just to give you an example, let's say that I pay you $25 an hour and you work 40 hours a week. This is your wage. You'll make $1,000. There's your earnings. You come to me and you say, I need a 20% raise. You want 30 bucks. So there's wage inflation, right? I say, well, I can't really manage this because it's a tight labor market. I got to give it to you, but I can manage the amount of hours you work. Now you make 900. There's your income. So when you're looking at weekly incomes and wages, you're mixing up two things because you have hours in the middle. So you have to have some way for controlling for changing wages and changing hours all at the same time. The best way is with an index because it normalizes for changes in these things. So we'll walk through the calculation of the index. Listen, the easiest way to beat inflation, if you're working 30 hours a week, and inflation is 10%. The easiest way to beat inflation is to work 10% longer, work 33 hours a week. There's a 10% raise. Well, that's not really wage inflation, but it is household income growth, right? And if we're determining whether or not an individual is outperforming inflation, we can look at on a wage basis, but what happens if there's no opportunity to work? Then it's even worse, right? Or if you had 30 hours a week, now you have 28 hours a week. So that's why you look at hourly and then you look at weekly. But because you got two things changing in there, you can't compare the two directly. You want to normalize it and create an index first. The index is the best measure of how much more you're going to the mall with on the weekend year over year, because that's what you spend. You don't go to the mall saying, I make $30 an hour. You go to the mall saying, I make $1,000 a week. All right, let's get into owner's equivalent rent, and we'll get into this. Last question here. In one of your talks with AJ, you told you want to use this platform for more social issues as well in the future. Are you planning any time for these? Yes, I am. It's just I got level 1 for 2023 up. 2023. Keep in mind, I still do this, right? Even though I sold a business, I still produce the videos. All the content is still me. I got that up. I got level 3 up. I'm working on level 2. Level 2 for 2023 is not going to be released until August. I'm about 2 to 3 weeks away from wrapping up my part on level 2. And then I'm off to this one, and we're going to talk about some of the big lies. The big lies that politicians like to tell. The first lie we're going to tell is that the rich don't pay their fair share. Don't pay their, I'll just put function taxes. Their fair share of taxes. That is a big lie. We're going to talk about that, and we're going to talk about where the tax cheating really happens. Then we're going to start looking at more broader issues like the idea of equality, and would equality actually work with humans? And hopefully I can show you that equality is a silly thing to hope for, much like this is a lie over here that the rich don't pay their fair share of taxes. They pay. All right, let's answer these questions. All right, let's look at how we arrive at OER. It is survey-based, and there is a sample of 50,000. At least based on the literature I have read in the past, it was 50,000. It might be higher now, but it's good enough for the basis of which I'm going to try to explain how it's done. This 50,000 is then divided into 6 subsamples, and each subsample is sampled twice a year. So if it's January and you want to calculate OAR for January, you sample S1. In February, you move on to S2. In March, S3, etc. Then you come back to S1 in July. So each household in the sample of 50,000 will be asked only twice a year, because, well, if you got to figure it out each month, the motivation would be to say, I just did this last month. Nothing has changed. It's the same thing. It would be hard to get an exact measurement. You need some time between your last valuation of rent for things to change, where you can then say, well, maybe things have changed and I need to go through the thinking process again. In year 7, let's say this started in year 1. In year 7, this sample disappears and they're done. Thank you for coming out. And a new sample shows up, because you need 6 subsamples. After year 7, this sample disappears and a new sample 2 shows up. So each household is in the sample for 6 years. They'll be sampled twice a year. They'll do this 12 times and they're done. And the question is, how much would you rent your house for, unfurnished, with no utilities included? Because utilities is captured in another measure of CPI. So it's just for the unit itself. Now, when they ask somebody, they identify households. Well, they have to get the household on board. They have to, show up or call or knock on the door and say, look, do you want to participate in this? Some households just say no. If people do want to participate in it, it's not as if they say, fine, we'll see you in a couple of months and we're going to ask you a question. They're given some information and a way to think about how they would come up with a price for their house. And it's not related to how much you owe on your mortgage or what your monthly payments are. It cannot be, because the owner's equivalent rent would then capture the capital structure you've used to finance your house. It would also capture the length of time that you've been in your house if it's related to your mortgage. So it's really related to the cost of running the property and the cap rate, or the required rate of return that you want to receive. So the cost of running your property would increase with inflation. So you got property tax, you have insurance, and you have general wear and tear. So, there's some education along that. You take your roof, whatever it costs to replace your roof. You take your whole HVAC unit, whatever it costs to replace that. Add that up, divide by 20, because they have a 20-year useful life. You'll take 0.5% or 50 basis points of the housing value as wear and tear or normal depreciation, because tenants will not care for a house the way you care for a house. And then you'll have some information on cap rates, or how to calculate a cap rate, or how to think about that, so that you can determine what a rental rate is. It's not as if we show up to somebody who owns a house who doesn't have much finance experience and say, well, what are you going to rent your house for? And between sips of his beer, he says, I don't know, $2,000. Thank you for coming out. It doesn't work that way. It's a more rigorous than that. And within all of this thinking, it's not, well, what is your mortgage interest? What is your mortgage rate? That is the cost of financing your asset. That has nothing to do with the rent. How you finance your asset has nothing to do with the rent that you charge. The rent must be market-based, and it is based on, for a large part, the cap rate, which is the required rate of return. Well, in very strong markets, cap rates tend to decrease a little bit. So that property values that are higher, you get a house that goes from $1 million to $1.2 million, a 20% increase. Cap rates may not be able to absorb a 20% increase in rent in the same area. So cap rates tend to decrease a little bit as housing prices go up. As housing prices go down, cap rates tend to increase. Here's some issues to think about when it comes to the shelter component of CPI. And remember, it's big, right? It's really big. San Francisco Fed's forecast for shelter inflation, 7% for 2022 and 2023. They expect it to linger for a while. They call this sticky. It's a sticky component of core inflation. The Dallas Fed calculates the correlation between a housing price index and owner's equivalent rent to be 0.75 at a lag of 16 months. So they'll calculate the correlation month on month with one lag, a 2-month lag, a 3-month lag, a 4-month, and they find that the correlation peaks at 16 months at 0.75. Here is HPI and CPI overlaid with each other. Look over here back in 2005. The HPI was peaking. This is the Case-Shiller Housing Price Index. But if you move on down, look at what's going on with the shelter component of CPI. It's showing a 5% year-over-year increase, whereas the housing price index has almost got a 14%. So there are some thinking that, oh, CPI is missing the mark. But look what happens. Housing prices turn down, but the shelter component keeps rising. This lag is about 16 months. And then the CPI component shows a huge price increase, and everybody says, well, what's going on? Housing prices have been decreasing. This thing is broken. It's not that it's broken, it just has a lag. It has a lagged effect in there, which is why the San Francisco Fed is saying, yeah, it's going to be around for longer because it's sticky. So now we've seen housing prices go up, and they're starting to do this. They haven't quite fallen. Some markets have corrected, some as much as 10%, but we expect this to happen to housing price index at some point in time. But owner's equivalent rent will do this even while this is turning down. This is where we are now. This is where that is. It's still going to continue up even while this has turned down. 16 months. Being that shelter makes up 32% of the CPI, being that the San Francisco Fed is forecasting 7% in the CPI all the way into 2023, given a 16-month lag. If we say housing prices peaked in February of 2022, that means that the shelter component for CPI should peak sometime in August of 2023. Wow. Listen, the people on the Federal Reserve on the Open Market Committee are well aware of this lagged effect. So they do take that into consideration. They know that, which is why their preferred measure is PCE. So while the CPI would ask a question, how much would you rent this for? The PCE is more along the lines of, if you own a home and you're renting it, how much are you getting? Versus how much would you charge? Because you can have sticker price and then you have discount from sticker price, right? We see this on Realtor.com, the share of listings that have reduced prices. Yeah, you can list your house at $2 million. Doesn't mean you're going to get it at $2 million. So the listing price, how much would you charge for rent, would be considered a listing price. That doesn't mean you're going to get it. Whereas the PCE is closer to the market, saying, well, okay, so you said you wanted $4,000 a month rent. How much are you really getting? Well, only 32. Aha, that's the number we're going to use, because that means somebody's paying 32, not 4,000. So the shelter component in PCE has less of an effect on the core than it does on CPI. However, if we watch CPI for a while, that shelter component is sticky, because the question is, how sticky is inflation? It is sticky. San Francisco Fed, Dallas Fed are both on board on this one. Okay, let's deal with wages and income. I've got table B3 and table B4 up here. This is average hourly and weekly earnings of all employees. And again here, all employees, but this is indexes of aggregate weekly hours. Pay attention to the word aggregate, all the hours worked, right? So let's start here. We have average hourly earnings and we have average weekly earnings. So let's take June. The average weekly earning here was $1,062, and the average hourly wage here was $30.52. If you divide it, that's 34.8 hours. Let's go to June 2022. 1106 divided by 3208. It's only 34.5 hours. Notice it's fewer hours worked. So if you're just looking at average weekly earnings, what you're going to end up with is a combination of a change in wages plus a change in hours. That's not very comparable. The best measure of how much of wage inflation is the year-over-year hourly change. There is wage inflation. But that doesn't tell us how well an individual is doing. We need to know what their weekly income is. And you can look over here, but now taking a percentage change is conflating two things. The best way to control for something is to normalize it. The best way to normalize something is to have some base year and create an index and look at the year-over-year change in the index, which then captures both those things happening at the same time. Because if you're working 10 hours a week and you say, ugh, inflation sucks, well then work 12 hours a week. You got a 20%, your income has gone up by 20%, even though your average hourly earnings has not gone up by 20%. That may be capturing household income, but it's not, or sorry, individual incomes increasing, but it's not capturing wage inflation. So you need two measures to determine how we're doing or how an individual is doing in terms of how they function as a consumer. We have to determine, well, what is going on with your income, not necessarily your hourly wage, because like I said on the first screen, 25 hours a week, $25 an hour, 40 hours, you're taking home $1,000, but you hit me up for $30, I cut you down to 30, now you're only taking home 900. Well, going from 1,000 to 900, even though you've gone from 25 to 30, 20%, you're really outperforming inflation, but you're not going to behave like you're outperforming inflation because you had a 10% drop in your income. Now you're super underperforming inflation. So we can't just look at wages. We have to look at the combination of the two, but then they become incomparable because you got two things changing at the same time. So let's look at the index. If we look at the index of hours worked, it is up 4.0%. So your earnings are up 5.1, your index is up 4.07. Multiply them together, you get 9.39, which is what you get if you take the change in the index, 9.39%. This is what you go to the mall with in your head. You go to the mall with the fact that you are up 9.4% year over year. You don't go to the mall with the idea that, well, I'm down 10% a year, or I'm up this much, or I'm unchanged year over year. The amount of my paycheck is the same, because that could happen. You could get a raise. Let's say last year you're making $1,000 a week. You get a raise, but your hours get cut. This year you're making $1,000 a week, and you say, I'm having a hard time making ends meet. We got to have some way to control for all these things changing at the same time. This is why we would use an index. Okay, let's go to B8 and B9. B8 is average hourly and weekly earnings of production and non-supervisory employees. We're taking management out. By the way, these guys make up, this crew here makes up about 4/5 of all employees. And here, these are indexes of aggregate weekly hours for production and non-supervisory employees. When we look at how much you earn per hour, this is capturing the opportunity to earn money. When we're looking at hours, this is capturing the opportunity to work, and your incomes are made up by both the opportunity to earn money and the opportunity to actually work. Let's look at hourly wages here, up 6.35% for non-supervisory employees. If we look at the hourly component from June 2021, 34.3 hours down to 34 hours. However, this is capturing aggregate weekly hours, which also captures overtime, right? So if we look at it this way, your hours have dropped, right? Even though your wage has gone up, your hours have dropped, so it's only really showing 5.2% increase in weekly earnings. Well, that's not quite measuring inflation or wage inflation. We've measured wage inflation over here. This resulting increase in incomes is a result of the change in the weekly hour. We want to control for all of that, so we'll use an index. If we use the index for hours, we get to 4.08. So if you take 1.0635 times 1.0408, multiply it out, it should equal the beginning value, ending value over beginning value minus 1, which is the change in the weekly payroll index, 10.6%. So in assessing the health of the consumer, it's not enough to just look at, well, how much did you make per hour? Because if their hours got cut down by quite a bit, well, they're in a worse situation. So we really want to pay attention to, what are you making per hour? How many hours a week are you working? What is the amount of overtime? Well, that's a lot of moving parts. The easiest way to do it is use an index, because it normalizes for all of that. So if we look at the index year over year, then we can say these people are going to the mall on the weekend with 10%, 10.6% more nominal income. Maybe their average hourly earnings aren't increasing by that, but they've got that much more nominal income in which they're hitting the mall. If we think headline inflation, which I still think is a wrong thing to use if you're thinking about how the consumer spends money, because it measures a price index. A consumer buys things on sale, buys 2 for 1, shops around. A consumer does a whole bunch of that stuff. They don't actually have to experience that inflation rate. How much are they going to the mall with? 10.6% more on an adjusted basis, adjusting for changes in earnings, adjusting for changes in hours worked, and adjusting for changes in overtime. In other words, it's capturing both the opportunity to earn money and the opportunity to work. And from here, you can then say, okay, well, I'm going to ignore CPI and I'm going to ignore PCE because it has owner's equivalent rent. From here, you would say, well, hang on a second now. These people don't experience owner's equivalent rent. They experience mortgage costs. You can replace owner's equivalent rent for the mortgage cost. What was the increase in mortgage expense over that same period of time? And you can adjust that for that to determine what they have left for everything else. It can get really complicated. Anyways, I hope that kind of sheds some light on that question. Maybe I wasn't too clear when I did it. I might have been conflating some of these numbers myself, but there we are. I hope that takes care of the questions this week, and next one is up on Sunday.